Welcome to the Explainer. Bitcoin has just seen a really rapid bounce after a pretty chaotic week, and it's got everyone asking one single crucial question.
So, is this bounce for real? I mean, the price is up around 8% from its low, which has got a lot of people feeling optimistic. But you have to wonder, right? Is this the real deal? Because, let's be honest, we've seen this movie before. These hopeful little rallies that just get completely rejected and end up leading to even lower lows.
And yeah, looking at the chart, this pattern feels familiar, doesn't it? It's not the first time we've seen an 8 to 12% bounce that turned out to be nothing more than a bull trap before the price tanked again. So that's the big question we're tackling. Has the market really bottomed out, or are we just walking into another fake out?
All right, to get to the bottom of this, let's dive into the case for new highs. This is the argument from the optimists, the people who believe the worst is behind us and we're about to gear up for a brand new peak.
So what are the bulls pointing at? Well, a whole bunch of indicators, stuff we call on-chain data, which is pulled directly from the blockchain. And what this data seems to be signaling is that the market just went through a massive cleansing event. You know, it was painful, for sure, but it's a necessary process that, historically, is a really strong sign that a local bottom has been put in.
I mean, look at that number. A 35% correction from the peak. Ouch. That definitely hurts. But, and this is a big but, it's actually right in line with the biggest pullbacks we've seen in previous bull cycles. So from a historical point of view, a really major threshold has been met here. And check this out. We've just seen the strongest capitulation from short-term holders in over a year. Capitulation is just a fancy word for panic selling, right? It's when the newer, less confident investors basically throw in the towel. And that's a classic signal. It's when Bitcoin moves from what we call weak hands to strong hands, the more patient investors, and it very often happens right before a big rebound.
And this is really interesting. Funding rates have gone negative. What does that mean? It means the market is so incredibly bearish right now that people betting the price will fall, the short sellers, are actually having to pay a fee to the people who are betting it will go up. The sentiment is just that bad. And historically, whenever you see that kind of pressure, a significant bounce almost always follows.
And the final big point from the bulls is this. So far, this cycle just hasn't seen that crazy euphoric blow-off top. You know what I'm talking about, right? Those wild peaks we saw in 2013, 2017, and again in 2021? None of the key indicators that usually scream, this is the absolute top, have even been triggered. So the argument is, the party's not over. Not by a long shot.
Okay, so that's a pretty compelling case from the bulls. But it's only one side of the coin. Not everyone is convinced. Let's look at why the charts might be saying no. The skeptics are looking at the technicals, and frankly, they see a much more worrying picture.
For the technical analysts out there, the way the price is moving is a huge red flag. They're arguing that the classic 4-year bull market cycle, it's broken. But even more important is that the price has been rejected by and is staying below the 50-day simple moving average. That's a huge trend line, and staying below it for weeks at a time, well, that's pretty much a textbook bear market signal.
So what we have here is this incredible conflict. It's a showdown between liquidity and the technicals. We're literally watching a duel between two completely different schools of thought for how to read the market. And right now, they're pointing in completely opposite directions.
So, in one corner, you've got the liquidity cyclists. These are the folks who believe that at the end of the day, all that really matters is the massive flow of global money, what we call liquidity. And in the other corner, you have the technical analysts. They believe historical price charts and patterns are the best predictors no matter what's happening outside the chart.
And the entire thesis for the liquidity camp, really, it all boils down to this one incredibly powerful historical observation. We have never had a bear market during a period of liquidity expansion. Never. And what's happening right now? Global liquidity is expanding.
And this is where we get to the great decoupling, the central mystery of what's happening right now. For the first time ever, Bitcoin's price is completely disconnected from that rising tide of global money. The price is falling while liquidity continues to rise. This has never happened before, and it begs the question, why?
Well, the answer might not be in the charts or in the liquidity models. There's a wild card. A new, powerful external force has just entered the arena, and this one has absolutely nothing to do with market mechanics. It's all about politics.
So what is it? Well, the index giant MSCI is proposing a pretty radical plan. They want to exclude companies like MicroStrategy from their global market indexes if their crypto holdings get too big.
Now, why does that matter? Because if that happens, huge passive investment funds would be forced to sell off billions of dollars of that stock. We're talking about massive automatic selling pressure.
Now, MicroStrategy's Michael Saylor, he says he's not worried. He's basically framing this as just another hurdle, another wave of skepticism from the establishment. He's saying, look, we've dealt with this from bankers, from accountants, from policymakers, and they all eventually came around. He's confident they'll get past this too.
But here's the twist. The source material we're looking at suggests this might be more than just a financial reclassification. There's real speculation that this could be a politically motivated attack. And that has a whole new layer of unpredictable, real-world drama that you're just not going to find on any price chart.
So where does that leave us? We've got this three-way collision of forces, right? You've got bullish on-chain data, bearish technical charts, and this totally unpredictable political wildcard. And things are about to get interesting, because key events happening this week could be what finally tips the scales.
Okay, so keep your eyes peeled. This Wednesday, we're getting key inflation and GDP data. That's going to heavily influence what the Fed does at its meeting on December 10th. And all the while, that potential MSCI news is just hanging over the market, with a deadline at the end of the year.
So here it is, the battlefield. It really is a tug-of-war for Bitcoin's future. On one side, the bulls have expanding global liquidity and all those strong on-chain bottom signals. But on the other side, the bears have some really ugly technical indicators, the major threat from MSCI, and the possibility of strong economic data that would discourage the Fed from cutting rates.
Which brings us back to the ultimate question. Will market logic or external pressure decide what happens next? Is the fundamental power of liquidity and the on-chain data going to win? Or will the weight of those bearish charts and this external pressure just be too much to overcome? The answer to that is going to determine if we're at the very beginning of the next great surge or the start of a long, cold bear market.